So we're talking about simple consumer loans. Um, when we talk about consumer loans, we talk about personal loans, student loans, line of credit, and car loan, which we're going to talk more in detail next week, and then mortgages the week after. Simple consumer loans can be secured or unsecured. Secured loans simply refer to loans that actually have some sort of a securitization, meaning you could have your car, your house, or a co-signer, a guarantor. Somebody actually signs it with you, or a simple, the paycheck that you're going to receive, or a pawn shop, that sort of thing. Unsecured loans simply rely on you and your credit score, as we discussed in previous weeks, and based on that alone, without any securitization, the financial institutions decide whether they want to lend you any money or not. So, with respect to the simple consumer loans, interest accrues on the balance, which we're going to talk in a minute, and the loan payments pay the interest first. And we're going to talk about a simple terminology called amortization. So let me switch to a spreadsheet. So let's say that we have a loan of about $1,000, right? And let's call this the loan balance, right? So let's say that this is a credit card and you used the credit card to purchase some items and your total balance is $1,000. Now, after you spend the money, you will have a statement period. After the statement period ends, you will have interest accrue. So you will have an interest. Let's assume, for the sake of this video, that your interest is about $100, right? So now you want to make a payment, right? So let's say that you want to make a $50 payment, and the problem with that is obviously that's less than your interest. So the if we call this your month number one, and then you actually start in month number two, what's going to happen is you actually will start with $1,000. That's your balance from the previous month, and then you now have $100 interest added to your balance, and then you will actually make a payment $50. And that simply means that your overall balance will increase because your interest is greater than your payment. So this is interesting because not every financial institution will require you to make the minimum payment that is equal or more than the interest. Some financial institutions will simply ask you to make a simple payment, something like $10 or $25, right? In which case, you basically are saying that your balance will increase, simply because you have a lot of balance and your interest is accruing, and you're not making enough payment to cover the accrued interest. So, just as a financial discipline, it is actually advisable that you would actually pay at least the interest, just so that you can carry on the balance as it is, without ever growing on you. So notice that once you actually make a payment, this actually pays the interest first, right? And then it actually goes to your balance. So if you're actually paying $125, the financial institution will actually take that $100 and then pay the interest first. And then the remainder of the $25 will go into your loan balance. So having said that, what is amortization, right? So we talked about the terminology, which we will talk about this when we're talking about the um, car loan and the mortgages. But amortization simply means that you are actually paying some part of your principal, your balance, and some part of your interest. So an amortized loan requires you to make a payment on a periodic basis, and that payment will have a portion of the principal and the interest. So this $125, for instance, the $25 is or goes towards the balance, and $100 goes towards the interest. So this is simply this amortizes the loan. Now, notice, like I said, we're going to talk about car loan and the mortgage next week, but both of them are actually usually, most commonly, are amortized loans, meaning once you actually take out those loans, you will have a payment schedule, and then each monthly payment will include the interest and then some portion of the balance. And then notice, let's say that you're actually paying a 2% interest. Um, well, that would be kind of too much. Let's say that you're paying 0.5% a month interest, then it simply means that you're actually paying about $5 a month, with a lot more realistic. And and as long as actually you actually make a payment that's above the $5, then you will be paying your interest, and then you will pay a portion of your principal. So let's say that you actually made a $25 payment. Your next month balance will be your $1,000 plus the interest minus the payment, and that's what that is. Now, if you actually do the exact same thing again, and so see, next month you actually have less of a interest burden because you have now a little bit less of a loan balance. So just simply, you will pay an interest, or in your payment, you will pay a portion of your loan and the interest. And as long as you pay down the loan, your loan gets amortized. So personal loans can be used for various purposes. You basically can borrow this to, um, to pay down credit cards that are a lot more costly than, consolidation loans, for instance. You could actually get a personal loan to buy a laptop, to buy, you know, fix your house, fix your car, that sort of thing. So it does require a good credit score if it is unsecured. You could use, for instance, a car title loan, for instance. You could use your car's title, if it is a clean title, if there's no lien on it, um, to secure the loan. And as you secure the loan, the interest that you pay on the personal loan will actually be lower, simply because securitization will make the loan less risky for the financial institution, and therefore they will actually charge less. So a lot of the times, personal loans will have a repayment period that's less than a year. You're talking about 3 months, 4 months, 6 months, but usually maximum of about a year. And interest rates are usually high. Um, so I said higher. Again, it depends on relative terms. It is higher than car loans and mortgages, but it usually is a little bit lower on average than credit cards, which are revolving personal loans. So we're talking about on average personal loan that you actually get from the bank. So what different types exist, like we had them here, we had consumer loans, which are personal loans, student loans, line of credit, car loans, and mortgages. So the personal loans are usually have higher interests than car loans and mortgages, but they're also usually lower than credit cards and payday loans and that sort of thing. So, but a payday loan is also a personal loan, and therefore it actually has a very high interest, and the repayment usually is less than a month. So we used a couple of terms: secured, securitization, and collateralized. It simply means that when you're applying for a loan, you could simply apply as yourself with your own credit score, and the financial institution will be basing their decision based on your credit history, and that would be unsecured and uncollateralized. Simple. personal loan. But if you're actually putting up some sort of a guarantee, for instance, a partner who can actually sign with you, a co-sign, perhaps a parent or a friend or a colleague who could actually sign with you, then you're basically providing a some little bit more security to the financial institution, and therefore you're making the decision easier for them, and therefore you're providing a collateral, you're providing a securitization, you're securing the loan for the financial institution. So another type of consumer loan is the student loans. There are two types. In fact, this week's quiz, basically asking you to do a little bit of a research as to the subsidized and unsubsidized student loans, and these are very common types. Subsidized means that the U.S. government is subsidizing these types of loans, but you need to be in a financial need, and these types of loans does not accrue interest while you're in school. But like I said, this week's quiz is actually asking you to do a little bit of a research on this, and I'm providing you with a link, um, an internet link for the government agency who's helping students to get these loans, and they do a great deal of good work as to explaining what it is and helping people understand it, and also get it and pay it back. So unsubsidized, usually students get these from private institutions, and there is no proof of financial need, and therefore anybody can get them. And but interest accrues while in school, and so the question is, if subsidized is so easy, uh, and I mean you're a student and you have a financial need, why even consider unsubsidized, right? So the this week's quiz, that with the government agency for the student loans, explains that in great detail, and they do a really good job. Financial need is the main difference between the subsidized and unsubsidized student loans. Another consumer loan is a line of credit. So we've used these terms back and forth: personal loans and line of credit, and then consumer loans. But the consumer loans overall is the main heading. And then within that, you have personal loans, and one of the consumer loans is a line of credit. So credit card is one of those examples of a line of credit. And then you could also have a store credit or store credit card. Store credit simply means like a furniture store who's actually giving you a revolving credit of, say, a few $1,000s for you to buy furniture from that store only, and then pay it back. And then once you pay it back, you could buy new furniture, or rent to own schemes in which you actually buy a furniture through renting it. These are all examples of line of credit. And a lot of the times, these basically rely on your credit score, credit history. It's very hard to secure these, although there are credit cards where you can actually pay, and pay before you spend it. So it's rather like a debit card, but the idea is for students, or for young people who are just starting their building their credit history. These types of credit cards, prepaid credit cards, are a good way to create a credit history, right? Build a credit history. We're going to talk about the car loans next week, but just as an introduction, because they're part of the consumer loans. Car loans are usually about 5 years, although you can actually get it for RVs and bigger vehicles, up to 10 years. They usually put a lien on the car's title. So what does that mean? A car has a title. You will have a little bit of a like a lien. It's called a lien. It will say the car is bought on your name, but the bank has the car was used as a securitization, or as a collateral for the loan to obtain the car, which means you can't sell the car unless the bank approves it. And if there's anything happens to the car, insurance makes a payment. Insurance won't make a payment to you. Insurance will make a payment to the financial institution, to the bank, who actually giving you the money to buy the car, and then that bank will actually pay um, you ultimately. But the idea is that once the car's title has a lien, a little note on the title that says the car actually belongs to you, but the car was bought on a loan, and the loan was given by this such and such bank, and therefore they actually have it's not a ownership per se, but they basically hold um, the title until their debt is paid. Most car loans will require an insurance for the car that you're buying, and a lot of the times this can become expensive because the financial institutions will require to purchase insurance sometimes that you might actually find it to be a little bit too much. And I'm not talking about the liability insurance. They're going to ask you to get insurance to against theft, again, the full coverage. So, for instance, when I bought my car, the amount of insurance that they actually had on it against theft was actually more than the car's value. And I ended up paying awful lot of insurance for it, and it was just to me, it was just such a waste. But it is what it is. The financial institution who's giving you a loan, they want to make sure that if the car is stolen, there is no gap. Gap refers to the amount of money that you owe to the bank and the value of the car. So let me go back to and we'll talk about this next week a little bit more in detail, but let's say that the car value is, oh, I don't know, say $15,000, right? And then you owe $17,000. So what happens is now there's a gap, right? So the gap is $2,000. If the car gets stolen and the insurance company pays a $15,000 because that's the value of the car, you still owe the financing company $2,000 more than what you would actually receive from the insurance. So that's $2,000 that you have to come up with. A lot of the times, you could actually see how people complain about this when this happens to a house. When you buy a house, the house value could be a couple of $100,000, but the value of the home can go down. However, what you owe to the bank would not. So, just like in this example, if the car value becomes less than what you owe for whatever reason, you will have a gap. There are some insurance companies who would actually offer a gap insurance, but they become costly too. So, um, but anyhow, so with respect to the consumer loans, car loans are a type of a consumer loan and they require insurance for the car. They will put a lien on the car's title, and then it usually is about 5 years. And week number 5, we will talk about mortgages, but as part of the consumer loans, mortgages are usually the least costly way to borrow money because they put a lien on the house title. It usually is about 30 years and it requires insurance for the house. And this, again, very much like the car, can be sometimes quite high and sometimes it could be to some extent wasteful. But if you're buying it on a mortgage, whatever the finance company says, that's what happens. So you end up having that insurance. So, but with the lien on the house title, it simply means you can't sell the house unless the bank approves it. Obviously, you owe money on the house. So, and then people refer to a term called equity. Equity simply means how much of the house did you pay down, right? How much of this principal were you able to pay down through the years, and how much of the house do you actually own? Um, in legal sense, you actually own the entire house, but then you owe money against that house, and therefore you don't really have equity until you actually pay it down. So, just to recap, we talked about simple consumer loans. Some subtitles could be personal loans, student loans, line of credit. car loans, and mortgages. Simple consumer loans can be secured or unsecured. And simple consumer loans, interest accrues on the balance, and the loan payments, the periodic payments that you make, they actually pay down the interest first, and then they are paying the balance. Therefore, the interest accrues on the outstanding balance. Um, and then amortization simply means that you actually have a fixed payment, which is, pays down the interest, all of it, and then pays down some of the principal. And then at certain, say on a mortgage, 30 years, you actually pay down entire interest and then the entire balance on the loan. Personal loans, a subtype of consumer loans, is can be used for various purposes, require a good credit score, repayment period usually less than a year. Interest rates are usually higher. Some examples, payday loans, which are very expensive and very, very short term. And car title loans, they're examples of a secured consumer loan and or collateralized, and they usually have a short period of payment as well. Student loans can be subsidized by the government or unsubsidized. Subsidized, you have to show financial need. And the good thing about it is interest does not accrue while you're a student. Unsubsidized, as soon as you actually borrow, interest starts accruing. Um, Line of credit, some of the examples that we already covered are credit cards and store credit, um, like a furniture store or some other type of store credit. And then car loan and the mortgages that we're going to explore more in detail. So that's about it for the simple consumer loans. If you have any questions, please let me know. And thank you for watching. Have a good day.